One sentence in the new tax bill could be the difference between overpaying by $50,000 or keeping it in your business, and no one's talking about it. I'm Trevor Densmore, founder of TJD Accounting Tax, where we help growing businesses across the U.S. legally reduce their taxes, protect their profit, and scale with confidence. This GOP tax bill just passed a major hurdle, and buried inside are changes that can permanently shift how business owners like you should structure your business, pay yourself, and claim deductions. I've broken the bill down line by line, and what I found could change how you approach taxes for the next 10 years. Today, I'll show you who this affects, how much you can save, and the moves you need to make right now before the door closes. Let's dive in. 100% bonus depreciation. For those of you who don't remember, 100% bonus depreciation is when you're allowed to expense the total cost of business assets during the first year of purchase. Before this tax incentive was introduced, we'll have to expense the cost of their business asset over the useful life of the loan. So for example, if you purchased a car that cost about $20,000, the typical useful life of a car would be about 7 years. You would have to break that $20,000 down over the course of the 7 years and then expense a portion of that over the 7 years. 100% bonus depreciation was introduced in 2017 in the Tax Cuts and Jobs Act. The bill expired originally in 2022 and started a phase down period of 20% per year. So in 2023, the bonus depreciation was reduced to 80%, and in 2024, the bonus depreciation was reduced to 23%. Now it's back and it has been made permanent by the new tax bill. If you purchased a business asset after January 19th, 2025, and the useful life is 20 years or less, and it has a business purpose, deduct that cost 100% on your taxes at the end of the year. It has also now been extended to include qualified business property. And that's not it. 100% bonus depreciation has also been expanded to include qualified production property. Qualified production property is defined as property that is used in the manufacturing, production, or refining of any tangible personal property. Now let's move on to qualified business income deduction, also known as QBI. This was another tax provision / incentive that was going to expire at the end of 2025, but now it has been made permanent by the new tax bill. This deduction allows qualified business owners to deduct from 20% of their net income. This is primarily designed to help pass-through entities such as sole proprietors, LLCs, partnerships, S corporations. Pass-through entities are essentially defined as business entities where the business income passes through to your personal tax return and is reported to the IRS on your personal tax return. Now, the next change I would like to discuss is the change to the excess business loss limitation. This is a tax provision that over the past few years has been getting extended, but was set to expire at the end of 2025. It has now been made permanent by the signing of the new tax bill. What this tax provision does is that it puts a limitation on the amount of business loss a non-corporate taxpayer can claim against other income in a single year. What I mean by non-corporate taxpayer are individuals like you and I and business owners of pass-through entity businesses. And these businesses include partnerships, sole proprietors, S corporations, and LLCs. The purpose of this tax provision was to keep high earners from using excessive business loss to write off their other income. So for example, if you were a W-2 worker and you also had a business on the side, this loss prevents you from deducting too much loss where you potentially write off all of your W-2 income. How this works is that it establishes a threshold each year. On this threshold is adjusted for inflation. For 2025, the threshold is $313,000 for single filers and $626,000 for married filing jointly. So as a single filer, if your losses extended past the $313,000, you would not be able to claim claim those additional losses. What will happen is the additional losses will become net operating loss carry forward, meaning that you will be able to carry forward that excess loss into future years so that you can write it off against your business income, positive business income in the future. The last modification I would like to discuss is the state and local tax deduction, better known as SALT. This deduction is the amount of state income tax, property tax, and sales tax that you're able to deduct from your federal return. In previous years, this amount was capped at $10,000. It's now been increased to $40,000. There is a expiration date. It is only increased for the next 5 years. So from 2025 to 2029, you'll be able to claim up to $40,000 in state and local tax deductions. This is big for pass-through entity businesses, such as sole proprietors, LLCs, partnerships, and S corporations. The reason why is because these entities, they report their business income on their personal tax return. With the state and local tax deduction, it allows business owners to take an additional deduction, which overall helps them to reduce their tax liability from any income that they've earned from their business. Keep in mind that there is a phase out for this deduction. At around $500,000, deduction starts to phase out and eventually gets reduced to the minimum amount of $10,000. It doesn't go below that, but of course, in most situations, of course, any business owner would want to take the max. This helps business owners because, again, it's another deduction that could potentially provide tax relief for business owners. Now that you know how one line in the new tax bill could change everything for business owners, it's clear this isn't about loopholes. It's about using the law strategically while there's still time. Most CPAs only react to tax changes after it's too late, but we specialize in proactive planning that helps you implement the right structure, claim the right deductions, and legally keep more money year after year. If you're a business owner earning real revenue and you're tired of giving too much to Uncle Sam, don't wait. Click the first link in the description to book a call with me and my team. We'll walk you through your current setup, identify missed opportunities, and map out tax strategies built specifically for your goals. Let's make this the year your taxes finally work for you.